Hello everyone and welcome to this webinar where we will talk about sustainable disclosure regulation, the new regulation in the UK. We will see how to effectively implement these new requirements. I'm Marion, I'm one of the co-founders of WeFin and in charge of the UK subsidiary of WeFin, and I will be the moderator of this session today. We are delighted to welcome you to this first webinar dedicated to the UK market, as we've just opened our subsidiary there. And as WeFin was originally a French company, we are helping since 2018 several investors through our platform to better handle their ESG data as well as implement new regulations. So we have helped them to implement SFDR, and we see a lot of similarities between the two regulations, and the objectives are quite similar. So if we look at what they're really trying to do, so building trust and integrity in sustainable instruments, trying to fight greenwashing as well, increasing transparency and disclosures around sustainable products. We will see today what are the best practices and pitfalls to avoid that have been learned from SFDR, and that could be really essential for SDR implementation as well. I'm pleased to receive today Nathalie Wallace, the Chief Sustainability Officer and member of the Executive Committee of Edmond de Rothschild. Welcome, Nathalie.
Thank you for having me.
We're really happy to have you today, and we know each other quite well, as you were former Global Head of Sustainability of Natixis Investment Managers, with whom we're working for several years. Thank you for coming and sharing with us your experience. As you were working for international companies, you have seen several types of organizations to try to implement sustainable regulations and strategies, and we're really happy to have your insights regarding this new regulation SDR.
Delighted to be here. Thank you.
Thanks. To properly frame our discussion, we will start our presentation with Sabrine, my co-founder and Chief Impact Officer of WeFin. And she will share with you the current framework, the different requirements, and share as well some insight about the observed practices. Just before we begin, we invite all the participants to ask the question they can have through the chat. WeFin team will answer them live. Floor is yours, Sabrine.
Thank you, Marion. Good morning, everyone. For the several past months, SDR, so Sustainability Disclosure Regulation in the UK has been a hot topic, a major topic, and it's followed a lot of other texts like TPT, TCFD, TNFD also, and it will constitute a real framework for sustainable investment in the UK, and it's new and complex, and many of you spend time trying to understand the requirements and navigate for all the rules. And in this keynote, I will try to give you an overview of the key elements, the key requirements of this regulation, but also to compare it with SFDR regulation, the European regulation, because there is some differences but also similarities, and maybe you can also leverage from European requirements in order to implement SDR. And also we will share with you some recommendation and also some lesson learned over the 3 years of experience with French and European regulation. So as you may know, you're familiar with SDR now. In 2021, the UK government announced its intention to make the UK the preferred location for sustainable investment by publishing the roadmap, the greening finance, and creating SDR. And there is 3 main objectives. So as Marion said, build trust and integrity for sustainable investment in order to avoid greenwashing, combat greenwashing, and increase transparency for all document, marketing document for sustainable investment, sustainable funds, and provide investors better information in order to make them better decisions. And what is interesting with these three main objectives, we can say it's quite similar from the European Commission Green Deal, even if the requirements how to achieve these goals are quite different from the two regulations. In line of these goals, SDR introduced four main pillars. The first one is the anti-greenwashing rules. It's effective since May 2024. This rule applies to all FCA authorized firms and ensuring that sustainability claims are correct, clear, complete, and allow for fair and meaningful comparisons. And this first pillar is interesting because it sets a foundational framework for communication. In France, we have the AMF doctrine that sets some rules, some threshold in order to ensure the information is clear, is accurate and misleading. But in Europe level, we don't have this framework for the entire communication for website, for marketing document. It's quite different. So SDR introduce upfront requirement for communication. The second pillar is naming and marketing. Terms like green, impact, climate must clearly match a product characteristics. This rule will start at the end of April 2025 after 4 months of extension from the FCA. And while SDR is less strict than ESMA guidelines, the recent ESMA's guidelines for naming on funds, because at ESMA we have some exclusions, we have some threshold, including, for example, exclusion from PAB and CTB index. It's not really easy for UK funds to apply recommendation of naming and marketing. And what is also unique on SDR is that this rule ties with product categories. We have focus, impact improvers, and mixed goals, while ESMA's guidelines cover broader ESG themes and strategies. And the third pillar is product level disclosure. We have two kinds of disclosure for professional investors and retail investors. For retail investors is the client-face disclosure. It's quite clear. It's more, we have more detailed about metrics, about strategies, about objective. It's really condensed information. And after the fourth pillar is entity level disclosure. In addition to product disclosure, firm must also produce report at entity level regarding their strategy, their risks, risk management, sustainability target. It's all aligned with TCFD requirements. If we focus on similarity, comparative analysis between SDR and SFDR, even if the two regulations share similar names and objectives, goals, key differences between the two of them present challenges for firms that operating in both markets. If we focus on flexibility versus prescriptive, both SFDR and SDR have elements of prescriptiveness and flexibility. SFDR is more prescriptive when it comes to reporting requirements, disclosure, specific KPIs, and SDR allows more flexibility in this area. However, SDR is stricter in defining product categories by introducing labels. SFDR does not do, maybe it will change with SFDR refit, but now we have only 2 classification. It's more large, and but SDR give investors the choice to not to opt in on label. It's not mandatory to have some label. It's if you have some funds with sustainability characteristics, you have only to comply with anti-greenwashing rules and product disclosure. On greenwashing focus, as I said, both the regulation aims to combat greenwashing, but their approach is different. SFDR focuses on regulating the reporting format, providing some structured templates to ensure consistency and transparency, and SDR takes a broader approach by offering high-level guidelines that need to be implemented on all form of communication. Data and reporting. SFDR, as I said, provide clear structure for reporting, a list of KPI for impact, the PIA, for example, while SDR allows for more customization, if we can say that. Despite these divergences, both regulation can be complementary. Firms can leverage best practice from both SFDR or SDR to inform their choice of indicators and how to avoid greenwashing. But we can say that if you can utilize some aspects for SFDR, for example, to meet SDR requirement and vice versa. And some lesson learned also, we can say that EAG regulation, EAG program are not a compliance, only compliance job. Over the past 3 years, we've learned that EAG regulations are not just a compliance exercise. It's an opportunity to improve the EAG strategies and to make all team to collaborate together. We have maybe 3 or 4 recommendations. The first one is we name it cross-functional collaboration. It's essential that EAG team, risk team, reporting team, data management team work together in order to meet requirements of all EAG regulation. And instead of rushing also to choose the most marketable option, you can align your existing strategy with the requirements, for example, with label, with all the naming rules, etc. It's also an important to not to wait the last minute to comply. All the regulation requirements are here in order to give you some recommendation, some rules in order to make your sustainability strategy more ambitious, more more advanced. And also, they are here in order to give you the opportunity to make your guidelines, your methodology clearer, more transparent, and to leverage it for your communication. And lastly, it's important also to create an target operating model, an evolutionary also target operating model. As regulation changes, it's important to stay ahead by embedding ESG into a core of the business, from risk mapping to strategy. So in conclusion, SDR, like SFDR, even though they are structured differently and have different requirements, represent a great opportunity not just to comply with regulation, but fully integrate sustainability into business model. And while this regulation presents challenges, they also give companies the chance to innovate, to be more ambitious. I will let now Marion and Nathalie take over, and they will share you some example of ESG program, and explain how to work with this regulation in practice. And also, I want to mention that our guide, SDR guide, is now published and has just been released, offering you detailed analysis of the FCA regulatory requirements, and give you also WIFIN's recommendation, and of course a checklist of how to implement it, this regulation, and which kind of indicator you can use, and how to navigate with all the requirement SDR, but also with TCFD, with TPT also. Thank you.
Thank you, Sabrine. So Sabrine has given her point of view on the difference and maybe the opportunity. We saw that SDR is giving guidelines in some points with the labels, but it's still really flexible on some aspects. From your point of view, Nathalie, do you see this flexibility, as Sabrine mentioned, as an opportunity, or may it add complexity as well for investors?
Well, thank you for the question. Between complexity and flexibility is always the question. I would like to come back and put SDR in the context of global regulation, with one very important point for, I would say, all regulation, is really to bring information that is relevant for end investors to understand the product. So yes, I think 2 points is one, coherence and transparency are essential. And thus, at 2 levels, I would say. One, at the entity level, it's who is the asset manager, is really to understand what positioning at the entity level. Is it an ESG risk integrator? Is it a sustainability purist, or a sustainability goal-oriented investor? And that is important for companies and clients to understand at the entity level. At the product level, it is really important to communicate what's the objective of that product. Again, in coherence with the positioning at the entity level. At the product level, is it a product that is here to, manage ESG risk only, I would say, or has several objectives that are more oriented towards outcomes, sustainability outcomes. And in both cases, transparency is essential to make sure that the client, the end client, understands what is the product delivering. And that's really where I think all regulation are putting the finger on what is important, coherence and transparency, and understanding the strategy of a product, as well as labeling in the case of SDR, and categorizing depending on this strategic objective at the entity and the product level.
And so, it's really clear that the strategy should be consistent from the organization towards the product level. And I think it might be complicated when you have a big company or big organization to be sure that the strategy is really spread into the different teams and there's a consistency even internally to ensure there's consistency at the end of the product level. So from your experience, what would be the best way to organize an asset manager?
Yeah, it's a good question. There are no best ways. There are ways that are aligned again with who you are. We are a family-owned business, woman-owned and woman-led, where sustainability is at the core of our strategy. We call ourselves genetically responsible, and that's over time. We are this family over time who has accompanied clients, accompany industrialists, actors of the real economy into massive transformation and several industrial revolutions. And that's the context. For us, sustainability is at the core, but we're not purist. What we mean by that is that we're here to really accompany the world and the actors and innovators, entrepreneurs into that transition. We finance at scale the transition towards a more sustainable economic model. And that's really who we are. In that context, for us, what makes sense is to have a very strong sustainability center, which allows for alignment, leadership, and support for what we called rooted ESG within different functions. And that's where we come to, in the compliance risks and legal department, there are ESG leaders who are responsible for execution. It is regulation. If it's ESG or non-ESG, it's the same. It is regulation, and thus ethically we are bound to really apply the regulation wherever we operate. So, but there is expertise in each segment and each department, so that we can execute better. With, again, a very strong sustainability center that really coordinates within the different functions. So that's how we organize ourselves to be able to deliver on the sustainability goals that our clients are looking for. Really, it's understanding the needs of the clients and being able to respond with that, with an organization that is really, again, where ESG is embedded within each function, with a sustainability center at the core.
And what is the link with the investment team, for example, because you mentioned compliance risk?
So yes, we became a member of the Net Zero Asset Manager Initiative last year. And to answer your question around within the investment team, each of the investment teams in our 4 different asset classes, we have liquid, private equity, infrastructure, and real estate. And in each of those asset classes, we have ESG and sustainability experts who are part of the investment decision and driving the investment decision. Most of our products are Article 8, some are Article 9. If we look at the SFDR regulation, so you see that for us, it is embedded. ESG risk control is quote-unquote non-negotiable. It's part of our fiduciary duty, and that's why we have expertise within the investment teams. And then when we have sustainability outcomes-oriented products or strategies, we have also this expertise within the investment functions.
Okay, and how is really organized a sustainable center? And I don't know, when there are big regulations to implement, how do you make, workshop, task force with the different relays you can have in the team?
So we are responsible for 3 things. As I said, yes, leadership. And when I say leadership, it's how to become extremely important, proactive within upcoming regulation. Is to really see how we can organize ourselves to be proactive. Second, coordination with, yes, the functions that are enabling the execution on regulation. Also working out with experts such as WIFIN to bring in this understanding and intelligence on future regulation, so that again we can prepare ourselves better. But execution remains, I will have to insist on that, at the enabling function in case of risk and compliance, or the investment function. And that is really important, because this is where you know, embedding ESG is not having for us, it's not only having, you know, a large group of centralized function. It's really to have it within each decision-making process, being at the risk level or the investment level.
Yeah, and it's not just one-time job and trying to implement SDR, but more something in long-term view, really in the strategy of the overall company, as you mentioned at the beginning, that's really in the core value of the business.
It is. I mean, just to answer with one example, we have established 3 kind of categories of our strategies, and that's across the firm, at the bank or the asset management. And so we have responsible-oriented strategies. These are managing ESG risks only for risk-adjusted returns, better performance. Then we have sustainability or sustainable strategies, which are focusing on delivering sustainable outcomes. And those are, you know, obviously integrating ESG risk, but also delivering on this transition, brown to green, as well as a sustainable outcome. And then we have impact strategies, and for us, they are only in private assets and only when the carried interest is linked to a sustainable outcome. So really, we wanted to be very transparent and coherent with who we are. This is what we have already. We have 20 billion in private assets and 40 in liquid assets, and all our assets are managed with this, I would say, classification of strategies, and so that clients are very clear on what they're getting when they're investing in those strategies versus the others. So it's really important for us to be coherent with who we are at the entity level and transparent with the products we deliver and strategies we deliver to our clients.
Yeah, and it's exactly the objective of SDR or SFDR is bringing transparency, trying to give information to retail investors. So Sabrine mentioned at the beginning that for the product level for SFDR, it's kind of easy, even if it's not perfect with the PAIs. What would you recommend for choosing the information to give to retail investors regarding one specific fund and how to choose the KPIs to share with them?
Yes, if I may, not reframe the question, but ask, you know, start from the top, and we talk about prescriptive versus principle-based philosophy. And I think that's the core of the discussion here. And I'll answer with an example. SFDR is very prescriptive. One example is the principal adverse impact, which must be reported on at each product, especially when they are sustainability-oriented investments, right? Not the ESGs per se, but this one. That's very prescriptive because there's a list of KPIs that must be reported on, some of which we have the data, but the coverage might be limited, and I'm not going to go into that. That's one issue. In SDR case, the focus was on delivering or explaining to end clients, retail investors especially, what is the objective of this product? You're buying a fund. What is it? What's the intention behind? And that's, I think, the major difference. One was focusing on transparency at all cost, I would say, and the other one on strategic or the objective of the fund. I think ESMA is coming to bridge that gap between the two. So for principal adverse impact, again, these KPIs, a long list, sometimes the objective of that fund is not linked to these KPIs. I'm just going to give a very small example. A low carbon fund or a lower carbon fund than the benchmark is not necessarily targeting biodiversity. And they're not claiming to target the risk of biodiversity or the objective to reduce that biodiversity risks. And that's where the tension comes. Why would you report on a KPI you're not managing? And you're absolutely clear with your client that you're not managing for that. And so that's where the tension is. So prescriptive or principle-based is really important to understand. We absolutely report on all the KPIs that are necessary under SFDR, but we have a big explanation on why this product might not be managed as expected versus this, because it's not in the actual strategy of the fund.
Yeah,
and it's really important to communicate that to clients very clearly.
Because even on their point of view, when they're choosing a fund, if they want to focus on climate or on social, they don't really mind if there's bad KPIs on one or the other.
Or lower KPIs. It might not be bad, it just might not be in line with other best performers on that specific KPI. And so normalizing with a very prescriptive approach, my threefold innovation, and what is very important for us, financing at scale. We really need more allocation towards sustainable outcomes. We think brown to green transition towards a low carbon economy, towards a more human-centric economy is extremely important. It's the challenge of today, not next 5 years. And sometimes too much prescriptive regulation can really impede fast deployment of capital. And that's what we have to be very careful of.
Yeah, and maybe the label of it's something that is less done in the EU vision, but the improvers label in SDR could be one solution on trying to engage with the companies and make them changing. Is it something as well that the Sustainability Center is handling, the engagement with the companies?
I think that's what big missing part in the European philosophy. This is really also who we are as a firm. So we strongly believe that as engaged investors, we are here to transform companies and projects we invest in. This is part of our role and duty as an investor. Again, it's transforming. I'm just going to give an example in real estate. It's great to invest in green buildings that are currently at the norms or below 1.5 or 2 degrees and align with the Paris objectives. We think it's even more important to invest in the 95% of real estate that is currently in place, and to retrofit and convert that real estate into a low carbon and more inclusive social proposition. This is where we want to be at scale. Again, this is where we think the challenges are. This is the hard to abate sectors, and that's, I think, where we can have the most impact, not as an impact investor, but more in terms of outcomes.
And if you're trying to share the information or everything that is doing for the different fund, we're seeing that the consumer-facing disclosure is more free on what to put inside. And I think a point that is different from SFDR as well is that if investors want, they can add financial KPIs as well. And I think something we discussed before was it's really your job is for the end investors, not just for the marketing and telling that you're doing sustainability for helping the world, but you are serving your clients as well.
Absolutely. And really one key point for us is there is no profitability without sustainability, and sustainability must be profitable. I don't know how to explain it several times, with different words, but the point is that for us, there is no difference. It is, the structural investment trends are here to stay. One, importantly, because our environments and our society on which we depend as a society, as human being, but also as companies, and in our case as bank and asset managers, need to be served, basically. But we think that it is important for our clients, to position their portfolios within these investment trends, or with consideration of the risks that are embedded into those transitions and the opportunities that we can position for. So it's really important for us. This is, call it double objective, but for us it's not different. And again, this is part of who we are at the core of our strategy, is that, again, sustainability has to be profitable, and profitability doesn't exist without sustainability.
And if an organization doesn't have this core values from the beginning, do you think it's still possible to implement this transversal sustainable center? Is it something feasible?
I'm not going to talk for every other asset managers and banks around the world and in Europe specifically. But, you know, again, yes, as I said at the beginning, it's really important, the coherence, understanding who you are and what's your role in the ecosystem as financier and investors, and then be very coherent, because it will be very transparent at the end and your product. We see that clients are very much more discerning of who is who. So it's really important to be coherent with your, again, philosophy, beliefs, and how you implement it and how you communicate to clients.
Yeah, and not every client is looking for always sustainable products. So if you're not really doing this, you don't have to. It has to be consistent with the entire strategy. Thank you very much, Nathalie. So we saw that SDR approach is principle-based rather than prescriptive. It does make it more difficult to start with because the FCA is not really always clear on what they are really looking for. But over the long term, we think it's a good approach so you as investors can really embrace this opportunity to drive your organization around sustainable objectives. SDR is not just about producing documents, and I think that was really clear through your answers, Nathalie, but it's about rethinking the ESG and the overall strategy. We saw as well that collaboration between teams is really necessary to ensure consistency, and this is possible through this transversal sustainability center that could be really a good solution to implement sustainability at scale. We do think as well on our side that tools can accelerate collaboration, so don't hesitate if you want to have a look at our website and our platform. We try to help investors better use their ESG data and ESG processes for SDR, for example. Thank you very much, Nathalie. Thank you, Sabrine, as well, and thank you all for watching us today.